In this week's video, we'll cover a stock market signal that just experienced an extremely rare and rapid shift. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In the first portion of this week's video, we'll be talking about the Copic Curve, an indicator that we don't use often in these videos, stockcharts.com. The Copic Curve is a momentum indicator. The goal of this indicator is to identify long-term buying opportunities in the S&P 500 and Dow Industrials. The signal is very simple. Copic used monthly data to identify buying opportunities when the indicator moved from negative territory to positive territory. We're using monthly charts here. It's a buy signal with the Copic Curve in 2003. If you know your market history, you know we rallied into October 2007. Here's the buy signal when the indicator moved from negative territory to positive territory. Right here. That's a long-term buy signal from a probability perspective. And it's commonplace to use a cross from positive territory to negative territory as a sell signal. Once again, we have a real-world example here. Positive territory in the Copic Curve. Here's the flat line into negative territory. After that, in calendar year 2008 and 2009, after we can see this and measure it, the S&P 500 lost an additional 52% from point A to point B. The rare part of this week's signal is a head fake or a whipsaw with the Copic Curve. If you zeroed in or zoomed in on this chart here, this is the S&P 500 monthly 1984 where my cursor is. This is early 1985. What happens here is the Copic Curve drops below the zero line. So you get a sell signal here from a probability perspective, but it's quickly reversed and followed by a buy signal. So we move from positive territory, close on a monthly basis, in this case in negative territory. That's a sell signal. And then immediately we get whipsawed and we get a move from the lower end into positive territory, which is a buy signal. Head fakes and whipsaws are relatively rare. This one occurred in the 80s. Another head fake in the 90s. In 1994, early 1995, it looked like the Copic Curve was flipping into negative territory on January 3rd, 1995. Like this signal here, this also turned out to be a relatively rare whipsaw or head fake. And a head fake type move also occurred in the monthly Copic Curve 2012, 2013. This is calendar year 2012. You can see in June of 2012, the Copic Curve is flirting with a sell signal. It gets down below 10 here and looks like it's going to extend below 0. But like these two previous cases, we get a head fake or a whipsaw. We'll consolidate these three charts to make room for the most recent chart. The same thing happened in calendar year 2016. We had a whipsaw. We had a sell signal on the Copic Curve. We went from positive territory to negative territory, stayed there for a relatively short period of time, and then we went from negative territory to positive territory, and on the last day of July 2016, we had a buy signal with a close back above the zero line. Since the Copic Curve is a momentum indicator, this tells us a lot about investor psychology. These head fakes or whipsaws are somewhat of a nimble barge. Typically, when the market rolls over into a longer-term downtrend, that's a process that takes time, and once you get the sell signal, typically stocks fall for a relatively long period of time, weeks, months, and even years in some cases. The exception is the nimble barge, where the barge turns around and it looks like you're going into a bear market or a longer-term downtrend, and then the barge quickly reverses out of character. That's what happened in calendar year 2016. All of the longer-term momentum indicators, all of the charts on multiple time frames, and even asset class behavior looked like we were getting the barge turning into a longer-term downtrend. This looks a lot like the early stages of a bear market, and it's very rare to see a look like this. The last time it happened was in the 1980s, because in these cases here, we did not get a monthly print below zero. In this case, we went below zero intramonth, and in this case, we got close. So this case here looks most like the case in 1984 and 1985. And in all four instances, the Copic curve turns back up in each case and stays in positive territory, which means unlike the sell signal, the buy signal remained in effect and there was not a second whipsaw. This gives us an illustration of why 2016 was a relatively difficult year for long-term trend followers, because the trends all shifted to defensive assets and then they relatively quickly shifted back to growth-oriented assets. That's difficult, but we can also get some excellent information out of it. Since it's rare, we can also see what happened next in each case. We'll focus in on these three cases here. There's also another case in the 90s that isn't as similar from a big picture perspective to these cases here, but if we did include it, it's also bullish. We get a similar situation here with the Copic curve, a short-term head fake. After that, good things happened on the monthly chart of the S&P 500 index. Now let's answer that what happened next question. Similar setup, similar setup, similar setup, similar setup. We know what happened next in these three cases. So in this portion of the analysis, our entry point for conversation's sake, or our point A, is basically this point here, here, and here. In the 1984-1985 case, after we could see this and measure it, after we had the nimble barge and rare look, this point A here is the same as this point A here. The S&P 500 gained an additional 87%, and the rally lasted for a long period of time into calendar year 1987. Similar situation in the 1994-1995 case. This point A is the same as this point A here, when the Copic curve gave us that head fake look and briefly dropped into negative territory. After we could see this and measure it, and after the reversal, stocks moved from point A to point B and tacked on an additional 158%, spanning 1, 2, 3, 4 different calendar years. We can see what happens a little bit with the concept of the nimble barge, and think of what happened in 2016. Early in the year, it looked like we might be moving into a new long-term downtrend, and thus defensive assets were your leaders. When the nimble barge makes that rare turn, it basically tells us that a high percentage of capital is allocated on the wrong side of the market, and as that capital shifts and the barge turns around, it provides fuel for those growth-oriented assets. And in this case, it fueled or helped fuel a multiple-year rally in the S&P 500. Similar situation with the third case. We have that nimble barge look. This is the negative look. Eventually it turns back up. This is the low here. This point A is the same as this point A here. After we could measure this and see it, the S&P 500 gained an additional 56%, and this move spanned 1, 2, 3, 4 different calendar years. Similar to our analysis in recent weeks, if we know what happened in these three cases, it may provide some insight into the market's return and volatility profile going forward. Our original lines in the sand, our setups, occurred January 31st, 1985, January 3rd, 1995, June 29th, 2012, and the most recent turn, where we closed back above the zero line, occurred at the end of July of 2016. In all three cases, the market rallied for at least 2.57 calendar years after the nimble barge setup. Therefore, our study period will encompass trading day 1 out to trading day 648. These are trading days, not calendar days. So we'll be moving from point A to point B, point A to point B, and point A to point B. So the next graph will show us the S&P 500 closed at 2173 in calendar year 2016 when we had this signal. What would it look like if the market from this point and this level followed a similar path, a similar path, and a similar path over the next 2.57 years? Here's the answer. This point here is similar to July 29th, 2016. We're starting at 2173, and then we're following the three paths from the three previous historical examples. If we went out 2.57 years, we would move from July of 2016, hypothetically, and this would be February of 2019. In one case, the market would have added an additional gain after the Copic Curve nimble barge signal of 105%, then 87%, and then 47%. Of course, we're not forecasting here. We're trying to gain an understanding of risk, return, and volatility profiles that might transpire over the next 2.57 years, in the hopes of better understanding that trade-off of volatility to ignore and volatility to respect between July of 2016 and possibly February of 2019. Since our signal occurred in the summer of 2016, the present day is in here, or March 8th of 2017, hypothetically. At this point, it's fair to ask the question, have we moved in a manner from July 29th of 2016 to the present day that we would expect relative to the moves over the first 153 trading days in these three real-world examples? Said in a simpler way, have we been following the script so far since July 29th, and does this movement align with these movements? If we project these three paths off of the July 29 move in the S&P 500 2016, in March of 2017, based on history, in one instance we would be at 2652 on the S&P 500, one instance 2407, and the third 2277. Therefore, if the market was following the script, we would expect the actual S&P 500 level in the present day to fall somewhere near or inside this range, which is exactly what we have. The S&P 500 was trading at 2362 on March 8th of 2017, and since we know based on these four historical instances, because this is now a historical instance, it's in the history books, March 8th of 2017 is similar to these dates here. We can also take the S&P 500's present level and project forward to the end of our study, or out to trading day 648, which is 2.57 years from trading day 1, or the day of the signal. Should be noted we have the signal in quotes here because we're not really big fans of the term the signal. It somewhat implies a binary occurrence. Nothing is binary in the markets, and all of this, as we know, simply speaks to the probability of good things happening relative to the probability of bad things happening, which implies, even under a bullish setup, the probability of bad things happening is never zero. So in the next graph, we'll say what happens if the stock market from March 8th of 2017 followed this path, and this path out to February 22nd, 2019. The answer, so far, we've followed the script. If we continued to follow the script, it's possible and purely hypothetical that the S&P 500 might fall either near or inside of this range here. So now we're looking at a hypothetical projection from March of 2017 out to February of 2019. And in this case, we might see something in terms of magnitude, 78%, 67%, and 36%. As long as we continue to follow the script and as long as the hard data aligns with this type of look, this information might assist us again with that most difficult volatility to ignore versus volatility to respect trade-off when we manage risk. And as we've stated in recent videos, our goal with the CCM market model is to capture as much as prudently possible of the move from point A to point B, while also prudently managing risk based on the hard data. And we know from recent videos that to capture the move from point A to point B, in all three instances here, you had to endure a lot of volatility along the way. Therefore, in the real world, how would we accomplish our goal using tools given the enormous amount of volatility that occurred from point A to point B? Here we're looking at hypothetical paths from 2017 into 2019. Now we're going to shift gears. Rather than looking at the hypothetical, let's look at the actual path for all three cases so we can understand a little bit more about that volatility and risk-reward trade-off. We'll walk through all three examples and then show a generic example of a tool used by the CCM market model to help us discern between volatility to ignore and volatility to respect. We'll start with the 1995 case. Our study period in this case goes from September of 1985, which is similar to the present day, March of 2017. And in the actual case, we move out to August of 1987, and that would be hypothetically similar to February of 2019. If we just looked at price, there could be a lot of tossing and turning at night, and we might have a tendency to overtrade our account, even within the context of what, in retrospect, is pretty easy to see that this is a rising trend. As we're moving along on a daily basis, it's much more difficult. Therefore, we can use moving average pairs to help us filter out some of this day-to-day volatility. In this case, from point A to point B, the simple 60-day, and this is just a generic and for illustrative purposes only, set of moving averages here, the 60-day moving average in blue and the 205-day in red. Notice during the entire move from point A to point B, we never get a bearish cross where blue drops below red. It's a lot easier to make decisions if we remove this volatile price from the equation, and the model focuses on the trend following tools. This looks a lot easier than this. Now we're going to take the same generic and for illustrative purposes only 60-day and 205-day and apply them to the other two cases and see if they were helpful. Now we're looking at the 1995 case, so this is where we get the nimble barge look with the Copic Curve, August of 1995. It goes out to July of 1997. This is similar to the present day, and this hypothetically would be similar to February of 2019. There's a lot of gut-wrenching volatility between point A and point B. If we add in the same two moving averages, we can see from point A to point B, we never get a bearish moving average crossover, and blue, the fastest moving average, stays above red, the slower moving average, during the entire period. This look here is quite a bit easier on the human mind than looking at disconcerting and toss and turn at night price in isolation. Now we move to the third case, 2013 to 2015. This is where our nimble barge signal occurred, February of 2013. We move out 2.57 years to January of 2015. This point hypothetically is similar to March of 2017. This hypothetically could be similar to February of 2019. Big move from point A to point B, but a ton of toss and turn at night volatility between point A and point B. If we add in our 60 and 205-day moving average, we can see we never even get close to a bearish moving average crossover, telling us that this is a very strong trend despite all of the volatility from point A to point B. And again, in this case, the third case, this is infinitely easier on the human mind and our emotions than looking at price in isolation. Obviously, the whole purpose of this analysis is to help us with the present day. If we look at the same 60-day in blue and simple 205-day in red as of March 9th, 2017 at 1:20 p.m. Eastern Time, we see we still have a strong trend look and a bullish look with blue above red, and we don't have anything that looks like an imminent bearish moving average crossover. If the present day were following the script off of the July 2016 low, we would expect point A, and in our case, point A is here because we don't know what the future looks like. We would expect the moving averages at point A to look similar to the moving averages on the left side of our projection charts, which is exactly what we have. We would expect this yellow box to look similar to this box, and this box here. And in all three cases, we have blue above a positive sloping 205-day moving average. This is another look that says, so far, the Copic signal off of the July 2016 low seems to be producing, as expected, using history as a guide. One of the main benefits of doing this is if we never had a bearish moving average crossover in all three of the historical cases, it tells us going forward, if we see a bearish moving average crossover, then it's possible that we're drifting from the script, and it tells us that bearish probabilities would increase. A bearish moving average crossover wouldn't be a binary showstopper. It just helps us with probabilities. Conversely, if we have volatility and we don't have a bearish moving average crossover and our profile still looks similar to the historical cases, it also tells us something about bullish probabilities. These moving averages here are an exercise in curve fitting, but we're doing that on purpose here because we're expecting the future to possibly follow a similar path and have a similar profile. And if the uncertain future turns out that way, then we would expect to maintain a bullish look with these two moving averages. Regardless of what happens, we learn something either way. If we maintain it, or we learn something if we get a bearish moving average crossover, because that falls outside of the historical script. And since one of the most difficult things in the markets is to discern between volatility to ignore when you have a look like this, and volatility to respect when defensive action is required on your time frame, we would hope that the concept of moving average crossovers would help us identify if the present day starts to morph into something different or if it morphs into volatility to respect. Since a picture is worth 1,000 words, the same 60 and 205 here, this is the look that we would want to avoid. We do get the bearish moving average crossover. We get negative slopes on the moving averages. This occurs in calendar year 2000. We can see this. We can measure it. It tells us the probability of bad things happening is higher. It doesn't mean when we get this cross we're going to go into a devastating bear market. It just tells us the probability of bad things happening is higher than it was here. After this, if you know your market history, the stock market really didn't bottom until calendar year 2003. The same two moving averages experienced a bearish moving average crossover early in calendar year 2008. which would have been extremely helpful. And in both cases, we can see the present day, March 9th, 2017, doesn't look anything like the peak in 2007, nor does it look like this lower probability look late in calendar year 2000. In fact, this look here compares much more favorably using the same two moving averages to the bullish turn that occurred in calendar year 2003. If you know your market history, you know the market rallied all the way into October of 2007. This looks similar to this period here, and this looks similar to this period here. And rather than looking like the October 2007 peak, the present day in this turn here looks more like the bullish turn that occurred using the same two moving averages in calendar year 2009. Therefore, using tools like moving average crossovers, those tools can help us discern between volatility to ignore and volatility to respect. And since in all three historical cases from point A to point B, we never saw a bearish moving average crossover, the same two moving averages in the present day can help us understand if it looks like we're still following the bullish script based on the Copic nimble barge turn that occurred in July of calendar year 2016. And conversely, if we see a look like this, it tells us that we're really not following the script, or at least the probability that we're following the script would be diminished. Therefore, tools like this can help us monitor and adjust rather than anticipate and hope. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.